So moving along to our next panel, we all know or have read about the velocity and pattern of global capital, how those flows are changing daily. Our next panel is made up of seasoned experts who are going to share their innovative approaches to opportunity and risk from a variety of perspectives, international banking, private equity, and various REIT platforms. Leading the conversation is Tinchuck Ng, who's the International Chair of the Real Estate Board at Cottonwood Management, which is a real estate asset management and development firm with over $2 billion deployed globally or under management globally, including close to $1 billion of it here in the U.S., Boston, and Manhattan. I am pleased to say that Tinchuck is also an MIT alum with a degree from the School of Architecture. And with that, Tinchuck, I'll turn it over to you.
Thank you, Steve. Whenever I get to moderate a panel, I always have the joy of either being before lunch or after lunch. So I know here my duty is get you all out on time to get access to the food. But I will say this morning when I was stepping into the breakfast room, the first thing I noticed was Charles and Ismael was looking at the notes that we sent out and diligently taking notes. So I know we're in very good hands between Matt's slides and all the hardworking panelists here. I certainly have not seen it. So I'm going to be the lazy moderator to start and have perhaps everyone's introduce themselves. I'm sure the audience wants to hear directly from you instead of from me. And then we'll move on to Matt setting us the stage for us with U.S. real estate. Is that good?
Very good.
Fantastic. Shall we start here?
Absolutely.
Okay. Well, my name is Ismael Clemente. I run a commercial real estate REIT pure play in Spain. So we are an investor, a developer, and an operator of real estate in Spain. Our philosophy is core plus. So we are relatively low in the risk return curve. We take little chances and we leverage with a maximum of between 40 and 50% our investments. We operate in retail, both conventional shopping center format and high street, in offices and in logistics / light industrial. Our geographical focus is Spain and Portugal, and we are an evergreen company. So we have no time span. We don't need necessarily to rotate investments or realize IRRs. We are more cash flow based or a dividend machine rather than a private equity kind of setup. We are almost 100% free float, highly diversified investor base, has rotated a lot over the last, we are a young company. We went public on the 13th of June 2014, so we are a very young company. Our investor base has rotated a lot. At the beginning it was full of hedge funds playing Spanish macro. Now it's full of institutional investors. Very, very interesting investor base now. About 50% of our capital is US, maybe 20% is UK, and then there is another 30% which is Spain, France, Germany, and varied nationalities. So that's MERLIN Properties.
Very good. My name is Matt Lynch. I head up UBS's U.S. real estate business. We're proud to be a partner of the MIT Center, and delighted to join you here today. Our platform is very different. We're a global real estate investment manager. We're a fiduciary in really every location where we invest. We're in all major geographies. We have $70 billion US under management globally. We have $30 billion here in the States. Here in the States, we have over 500 institutional investors. Even though we're part of the world's #1 or 2 wealth management platform, almost all of our capital is institutional, and almost all of it is core and core plus or value added. We also do debt strategies in a number of countries, and in Japan, we are partners with Mitsubishi in running 3 large J-REITs. Platform is actually extremely diverse, which actually represents the diversity of real estate around the world. I think one of the things we should be able to prove is that all generalizations are wrong. So in real estate, the generalization is it is different everywhere, and I think we can probably prove that that is, in fact, a generalization that's true. So pass it on.
My name is Brian Antonellis. I work for Independencia Asset Management. We're a group out of Chile that invests high net worth and institutional capital in the U.S. We have 1.7 billion in assets right now in the U.S. We started investing in 2005. We're really ramped up over the last 3 to 4 years here. Every deal we do is individual, so our equity makeup in those deals is very different. Some is primarily institutional based on the type of returns and the risk, and we have some investors that are looking for more risk and higher IRRs, but most of our investments are long-term holds within the U.S.
My name is Charles Graham. I run with others a company by the name of Europa Capital, which as of the last 5 years has been an indirect subsidiary of Mitsubishi Estate, and we look after investment management activities only in Europe. Mitsubishi, through the Rockefeller organization, has a number of similar interests, including a more recent acquisition of a controlling stake in a group here based in Boston as TA Associates Realty. And the idea really from Mitsubishi is one arm of its activities is to grow its investment management or third-party asset management business. It also obviously is a significant investor and developer, and I think the largest Japanese property company by market cap. We only stick to Europe. TA only sticks to the US, and our activities involved with commingled funds, mostly in the value-add space, but also growingly in mezzanine debt and separate accounts, and using the Mitsubishi balance sheet to actually look at individual assets in joint venture.
Great. So Matt is very kind to have a set of slides to show us and start setting up the stage for us with U.S. investments, because a lot of the talk in the press that we've been seeing the last couple of years has been inbound capital coming to U.S. from different parts of the world.
So thank you. I do have some slides here today. First of all, while you're in East Cambridge, I implore you to visit Cambridge Side Galleria, which is only a few blocks from here and is in one of our open-end funds, and I'm sure that if you will find many delightful things to buy here. The Apple Store is recently renovated, and I think you'll find it also an interesting real estate investment. So, as I said, I head up UBS's U.S. real estate business. I'm going to very briefly look at, this is how we look at our overall business, because I think when everybody talks about these things, connecting to the generalization point, everybody really does so from their own perspective. It's hard to get outside your own perspective. So I just thought I would share what ours is. We manage $30 billion in the United States. The topic of this panel is cross-border capital. The amount of cross-border capital we have in our platform is about 5%, which is a relatively small percentage, but it's actually quite meaningful. The way we invest is actually mostly through open-end commingled funds. So in contrast to some of our other panelists here, these are mostly investments directly in funds, and then the funds are investing. We run the largest open-end fund that is available to non-U.S. investors, called Trumbull Property Fund, which is about $22.3 billion of total assets. We're a diversified manager. We're in all 4 major property types as well as hotel. Interestingly, we also do farmland on the side. I'm going to very briefly touch on farmland because we are seeing an increased amount of non-U.S. investor interest in U.S. farmland. It's a completely different asset type, but it has its own return history and its own benchmarks. There's a very few managers in the space, but there is an increasing amount of cross-border interest, and actually in that platform we have north of 15% of capital that comes from outside the U.S. But farmland is relatively small. The entire investable universe is less than industrial in the United States. And from an institutional perspective, less than 3% of all U.S. farmland is owned by institutions. It's very small penetration. So returning to the much larger world of real estate, most of our capital that comes in through open-end funds. We have been significantly increasing the amount of non-U.S. capital that comes in through that platform. At this point, we actually are investing much more cross-border into Europe than we are into the U.S. The bulk of capital that is cross-border coming from Asia for our platform is actually coming in to Europe, mostly through club deals and individual transactions. In the U.S., it's still relatively small. We are part of the world's largest wealth management platform. UBS has over $2 trillion of assets under management, but our platform is almost exclusively institutional. We are working to change it, but quite frankly, institutional capital overall fits a little better into the long-term structures that we mostly run. So now that's sort of where we come from. We invest in all major markets. We're a major market investor. We have over 10 billion of apartments, over 45,000 apartments. That's our largest single segment. But we're in all major property types and all markets in the U.S. So I'm going to look at some data to try to set the stage, because this is in part about cross-border investing. And I think it's always useful to try to begin with some data. So here we look at overall U.S. transaction data. Real Capital Analytics has the best data in the field. And we tend to look at this on a quarterly basis. This is U.S. transaction, all commercial and multifamily. This is the best data there is for the entirety of transactions. It excludes transactions that are smaller than 5 million. But this is the best representation of the overall institutional market. We include on here an average quarterly transaction volume over since 2001 of just under 60 billion a quarter. You can see that 2015 was at quite high levels. That we've now exceeded the prior peak in transaction volumes. Yes, on the right-hand side, you see a lovely office building we've just purchased in Portland. And if you're in Portland, no, I'm just kidding. So here, U.S. transactions by buyer type. So RCA data provides a way to look at where capital is coming from. So you will see that there are 6 categories here. Cross-border is in the blue, institutional equity funds in the light brown, the dark brown listed REITs, gray private, green user and other, and the famous unknown. So when we look at this, this shows the entirety of the data on an annual basis. The prior slide was on a quarterly basis. And you see the 2007 data actually still exceeds 2015 on a quarterly basis. We've exceeded it, but not on an annual basis. So on the right-hand side, we show cross-border share of total U.S. acquisitions. So one of the key points I want to make here is that you will see that only in 2015, according to RCA data, did cross-border capital amount to more than 10% of overall transaction volumes in the United States. And the U.S. is the largest and most liquid market in the world, and it's still only 10%. The question, I think, is, was 2015 an aberration, or is it the beginning of a trend? It was over 16%. That was driven by several remarkably large Chinese acquisitions, actually. It's not as many transactions as it appears. It's a lot of large transactions. But at this point, I'd like to point out something, and having a really good research department really helps when you're trying to learn something like this, because I started asking some questions about this because I didn't understand the data. So I said before, we're part of UBS, the large Swiss bank. We're headquartered in Zurich. You might wonder how RCA figures out where this data comes, where these assets come from. How do they figure this out? Because we've all seen what a property transaction looks like when it gets in the record. You really can't tell from the record what in fact happened. How do they do it? Does anybody here know? I didn't know before I started asking. They look at the street address of the ultimate parent of the acquiring entity. So our ultimate street address is in Zurich. So 100% of the transactions we executed in the United States were shown as being cross-border. Now, I've already told you, some of you will remember, that it was actually less than 5% of the capital we manage is in fact cross-border, because we actually know where the capital comes from. So 5%. So 100% of our transaction volume is shown as being cross-border. So that begins to show you the depth of the methodological problems in the data. It's not simple to figure out what, in fact, cross-border capital is. And when you begin to be thinking about these issues, it's really important to see how difficult it is to define even what cross-border capital means. Now, I don't want to scare you too much about the data, but this last year we did $4.5 billion of acquisitions. Real Capital Analytics confidently showed that we did $1.6 billion. Where was the rest of it? I don't know. It's not in the record. So it's sort of like when you read an article in the newspaper, usually you don't know what happened. That's usually what happens. In a small number of cases, you actually do know what happened, and it's usually pretty disturbing how different those two reports are. Now, having said that, Bob White does the best job in the industry. This is the best data there is. And I think probably the biases, and they're not intentional biases, are probably fairly consistent. So even if the absolute numbers are wrong, the trends are probably right. And in general, we are seeing an increase. Obviously, the most significant increase, trend here is increased transaction volumes. And cross-border, more than 10% for the first time ever in 2015. So as I click ahead, or try to, there we, whoop. Okay, so also RCA data, because we're also talking about how cross-border affects development. So here we have some data. So you'll remember in the prior slide that the total transaction volume was a little more than 500 billion, okay? So let's click ahead. This is the same data source for what they call as development sites. This isn't all of development, but again, it's the best data there is, so you got to start with something. So the total amount of transaction volume in the United States in 2015, a little less than 25 billion, okay? So that's about 5-ish%. So let's look on the right-hand side. We're showing the cross-border share of development sites in blue. You will see that cross-border acquisition of development sites peaked at the prior time when, at the absolute worst time possible. That probably has had some effect on what's going to happen in the future. That is, the biggest peak was in 2007. This is the blue, where it was 16%. We've reached those same kinds of levels. And so another point to draw from this slide is that the cross-border share of development sites is about the same as it is for the total amount of acquisition volume. And we're also seeing, the other thing to note from here is that there is an upward trend here, but it's more erratic in the development site. So, and yet, it's important to note that cross-border transactions are dominated by existing assets. This is the same data set shown on an annual basis, and on here, development sites are shown in blue, and you can see that their overwhelming amount of acquisitions are actually in existing buildings. This is for us most of what happens too. And mostly that's because there's a pretty significant yield premium in the United States versus other developed economies. And so there's obviously overall a global search for yield, and there's yield in the United States. And here's our lovely office building in Seattle, if you happen to be in Seattle. It's right near Starbucks. So the next slide shows where inbound development capital goes. So again, the same data source, and here we're looking at it in two different ways. On the left, it's basically a heat map of where that development capital goes, and on the lower right, you see the destinations. This is not very dispersed. Development capital on a cross-border basis almost entirely goes to a handful of places. It goes, you'll notice that Manhattan is the first one here on the right. Actually, there's so many nested circles there, you can't really see how big it is, but it's $1 billion there. And then you will see that New York City boroughs, so that's mostly Brooklyn when you look at the data, is third largest. San Francisco is the second largest. Boston actually gets some of it, and other is pretty meaningful, but it's actually very, very concentrated. Most developments, cross-border development sites are in Manhattan, and secondly, in San Francisco and the East Bay. Where does it come from? Question?
Interesting that the LA doesn't even show up in the map, which from on-the-ground data perspective, we see that every day.
It's a very good point. You would think that LA, being the second largest economy in the United States, would attract a larger portion, and I can't tell you whether that's a methodological problem or whether this, in fact, accurately describes what is, in fact, happening. So where is it coming from? Well, on the upper right, it's pretty obvious where it's coming from. China dominates here, and obviously a lot of Hong Kong capital is really mainland China capital. And it's coming, that's a way station. So if you were to combine those two, which is a little aggressive, but you would see that that dominates it. Traditionally, Canada has been the largest cross-border investor by far, and in fact, that's a little misleading because the US-Canadian financial system is almost integrated. They're not, but they're almost integrated, and Canada is the overwhelmingly large foreign trade partner for the United States. So this data looks quite different because the amount of trade with China is absolutely dominated by trade with Canada. So this really shows how different the flows of development capital are and how dominated it is by one source. So we'll see where this goes in the future, but so China is absolutely dominating cross-border flows. So I touched on this a little bit before. Why the U.S. and why existing? We like to think of this as basis spread over the domestic risk-free rate. Now, global investors will have different risk-free rates that they will frequently look at. But we find, given that we've already seen that most investment in the U.S. is, in fact, domestic to domestic, and in fact, that's true of almost all countries, the majority of investors look at it this way. So here we're showing actually very, very wide spreads. This is why there's investment in real estate globally. This is why everybody in this room doesn't have to worry about finding a new job next year. I'm not kidding. This is the most important chart I'll show. There still is a remarkable amount of spread between real estate returns and the risk-free rates everywhere. And a lot of, you can say, well, risk-free rates are abnormally low. Well, I would say they've been abnormally low for an abnormally long period of time. They're likely to remain low. So this is why you get a lot of flows of capital into real estate and why each of us on the panel has a lot to do and why there's investment in lots of different countries. It's not as if there's one country. Germany is actually the outlier here, but that's because their risk-free rate is probably absurdly low because it's about 0. And so the US shows pretty well here, but a number of countries do. These are all wide spreads. We actually tend to think about as real estate is reasonably priced at a 200 basis point spread. Obviously, it's much wider spread than that. I'm not even going to mention the two lovely assets we have pictured on the right that are in our portfolio, so I'll just move on. So this shows in the US, and a similar kind of thing shows in each of these. And so in the first quarter, we've actually seen a widening of spreads. Transaction cap rates actually rose a little bit in the first quarter, and the risk-free rate fell. And you see here is the overall spread in the US. And so, there we go. And so the last point I'll make is that occupancy in the U.S. in general is continuing to increase, and rent growth by each sector is actually very strong. So this is really this is another reason why, and I'll close with this point and turn it back, that this is not 2007, even though pricing is actually fairly similar. There is organic growth in occupancy and rents in the United States, and that should lay the groundwork for continued strong returns going forward. We're not, this is also not an overly leveraged point in the cycle. So with that, I'm sorry, I lied. I have one more slide. So the other thing that U.S. investors are thinking about, and they have been thinking about, is what happens to real estate returns in a rising interest rate environment. And we've all been thinking about this for a long time. Most of us have not ever been investing in a period where interest rates were not falling. Interest rates in the United States have been falling since the early 80s, and we have two rates here, the Fed funds effective rate, which is the policy rate. This is the rate that the government actually controls. That's the light brown line, and you can see that and the 10-year rate used to be a lot closer. They're quite far apart, and obviously the policy rate has been at 0 for quite a while. The 10-year rate is still less than 2, but it's a lot more than the policy rate. This is the NCREIF Property Index annual total return, so that's income plus appreciation. So the bands here show periods, the unusual periods during the time since 1983 when interest rates have actually been rising. Everyone has been convinced that interest rates are about to rise, so that must be happening again. What's actually happened, oddly, is that in each of the 5 periods where we've had rising interest rates since then, real estate returns have actually increased, which is completely anomalous, and how could that possibly be? And the real reason is typically interest rates go up because there's an increase in demand in the economy, and real estate benefits from an increase in demand in the economy. At this point, it's possible that that could happen, but I think the key thing is that there's still a remarkably wide spread between the risk-free rate and real estate rate, so it's likely that there's enough shock absorber there that's where most of the movement will be. I think that the discounting is probably about 50% that there will be a interest rate increase. That's why the equity markets are doing poorly these last couple of days. So we probably will have to be thinking about an increase in the policy rate in the U.S. in the very near term. With that, I'll turn it back. Hopefully we've set the stage for a few things about cross-border. No test on the disclaimers on cross-border capital.
Thank you, Matt. I think that's a great. You certainly set out some controversial points that I'm sure the panel will enjoy discussing. Now that we have the sort of 50,000 miles view, Brian, I'm actually curious now that on the ground data that you are living every day into inbound capital into U.S., what are you seeing as some of the trends in the last few years?
So especially in Boston, I mean, we invest throughout the U.S., but in Boston, it's been amazing seeing the amount of cross-border capital come into Boston. I was telling you earlier, when we started here in 08, 09, we were really the only people investing in Boston from outside of the U.S. And since then, it seems like every deal that we go after, there's some other foreign entity that's bidding with us, and it's been great. It's great for the city. I think it's helped the city grow and has kind of put it on a trajectory that I think is a good one. And we've kind of moved on and looked at, I mean, we're still really engaged in Boston. We've looked at some of the secondary and tertiary cities, and we've been in those for about 18 months now. And we're starting to see other foreign capital enter those markets as well. So I think it's been a good thing overall and is creating more competition, which is always good.
Do you see most competitions in stabilized assets as what Matt is pointing out, or are you starting to see either migration towards core assets into tertiary markets, or are you seeing rotation towards riskier life cycle?
For us, it's been core assets in secondary markets that we've seen a lot of growth in. I think there is, for us, there's some appetite. Some of our investors have now thought about getting into more risk and looking at some of the development side of things and getting into some of the secondary markets around a primary. So we've now gone out to the suburbs. We've bought a couple buildings around the 128 belt here, and I think there's go ahead.
Still income stuff? So
Some's income, some's more value add. So something that has a little bit more risk in it, but is has some yield over the first couple of years, and then you have more value add there.
what I thought was also very interesting, it's you still, I think, as Matt captured, and I'm curious to hear on the European side whether it's the same, cross-border capital tends to gravitate towards that income component piece, even as markets move up, that still seem to be a big driver. And we're certainly living it in our deals and trying to figure out how to structure that into development. So, but one question for you, Matt, is you mentioned farmland. With all your open-ended core investors, farmland, and that's where you're seeing cross-border inflow. What do you think what type of investors and what do you think is driving them?
Several different things. Mostly these are large institutions. This is not really food security investors. You do see some national sovereigns who are looking at this as a food security issue, which is actually very troublesome for the markets and is disruptive and has the potential to lead to legal restrictions that have gone on in a couple of places. It's become controversial, say, in Australia because of food security investment in the ag sector. Most of these are large institutional investors. They like the long-term returns. So for the last year, the returns have been basically about 4% income. There's actually lower income in the farm sector than in real estate when you compare core to core, and 3.25% appreciation, so more than inflationary appreciation over the last year. This is significantly lower than it has been during the prior period, and that's mostly because there were the growth in demand is actually going to be lower this year than it has been. So this is actually a better entry point than it has been for a while. We will have the highest amount of corn production in the United States. The one proxy you can use for overall farm production is corn. It's the largest single crop. And China is actually growing its demand at a slower rate. So the second derivative is negative, than it has been in the past. But China can't feed itself today, although that's not its official line, and it will not be able to during our lifetime. It is improving its production of food, but the U.S. continues to be by far the most efficient and largest producer and exporter of food in the world. Canada is also an outstanding producer, but it doesn't have the diversity of crop types. So we're seeing income, demand for income, and also long-term stability. And a 7.25% is a completely unleveraged return. So it's a stable long-term return, and it's also very strongly correlated with inflation. You actually do get a higher return from ag when inflation increases. It's a much higher correlation than in real estate.
And geographically, where do those investors typically come from?
They come both from, about 2/3 at this point of ours come from Europe and 1/3 from Asia.
Interesting. Wow. Now, speaking of Asia and Europe, Charles, I'm certainly seeing every day my investors asking me, how do we access UK? How do we access Germany? What are you seeing on the ground?
Well, I think we've got to differentiate between the value add opportunity and the core. I think the perception, whether it's right or wrong, was that Europe was perhaps slower to recover and therefore continue to offer more opportunities than the US, which is a little further along in the cycle on the value add side. Having said that, within the market, it seems quite competitive. So if the US is more competitive, then it's very competitive. But I think we're seeing quite a lot of capital, cross-border capital, coming into the market indirectly through some of the mega funds, particularly US managed mega funds. And so I think there's sometimes a disguise in terms of the amount of cross-border capital coming in that way. And you know, we've seen most of the larger deals, of course, are then focused on by those sort of groups. And then there tends to be a sort of food chain that goes down with people feeding off the things that the larger groups are unable to do. As far as core investment is concerned, there is a very strong domestic institutional market in some of the major countries, Germany, obviously, the UK. I think that you know, the yields have continued to compress. We've seen flight capital coming in particularly to the UK, which is by far the largest institutional market in Europe, and we've seen these yields continue to compress. Of course, we will look at it rather short-sightedly, and we have to look at this on a global basis, that actually getting 4.5% in London with a view that maybe that it's a reasonably safe environment is probably quite good if you're actually being asked to put your money in a bank, you know,
right.
in Singapore. So I think that continues. In Germany in particular, I'm not quite sure how this works, but they tell me that most institutional office buildings are now in institutional hands. I mean, you have to look very, very hard to find a proper institutional office investment in Germany.
Right. And
we're starting to see those yields again continue to go down, you know, to the extent that you'll have 20 or 30 groups looking for a, you know, a professionally marketed office investment in any of the major cities in Germany at this point.
Do you see then capital rotating out to tertiary markets or moving into riskier assets?
Well, I think it does go
countries?
into tertiary markets, you were saying? Yeah. I think it does. I mean, when you say tertiary markets, I think you have to look within tertiary locations within what you would call the leading countries,
right.
Or are you talking about the secondary, I hate to say, tertiary countries within Europe? I think there is a trend to both, and it can be dangerous to the extent that the pricing of secondary and tertiary assets rises like the tide bringing all ships.
Right.
But also, I think if you look in some, for instance, the Central European markets, the yield compression continues there as well. Not in every country. I think Bulgaria, Romania, probably a little bit slower to recover from the crisis, but certainly Poland, Hungary, surprisingly, which was a latecomer, and the Czech Republic are, you know, have moved. They're a premium to, in terms of you can get better yield than you can in the Western Europe, but at the same time, Poland is particularly receiving a lot of attention.
Do you see that it's cross-border capital acting on its own, accessing these riskier assets, or it's led by some of the, you know, mega funds?
No, I think you see individual investors coming. Yeah, I mean, when we market a building for sale, it's interesting to look and see who's there on the list. And you tend to find, we just sold a shopping center, actually an outlet, fashion outlet mall. That's an interesting situation. There aren't many, particularly because of planning restrictions in Germany. I think there are something like 8
right.
or 9 in Germany. But that yield has now compressed to the extent that institutional investors are now looking at those kind of what were sort of slightly strange asset types and actually pricing them similar to mainstream retail. Probably seeing that the actual growth is perhaps more perceptible than it would be in the main retail environment. So you'd rather be in a fashion outlet mall with growth than you would perhaps be in a slightly secondary retail asset where you're a little worried about e-tailing and et cetera. So these are quite interesting trends to see. Student housing is another one.
That's right.
Where you've seen the move from, you know, the opportunistic down into the core. The UK is now considered really to be a core asset class. Whether or not it's been priced, you know, to over the top in some cases, I personally believe that the UK market has been slightly overbought. But I think there's still opportunity because it's so diversified in continental Europe that that's an interesting play. But
do you think that type of movement is led by domestic investors who know their home market well and is willing to push to different product types, or it's really cross-border capital leading some of these initiatives?
No, I think we're seeing cross-border capital on top of domestic capital. The outlet mall actually we sold to a German institution. An office building in Paris, which we thought would go to a domestic institution, went to a Middle Eastern family office.
Wow.
And I think there's quite interesting in the Middle East, and I'm sure there are much better experts here in the Middle East than I am, but there are an awful lot of people who individually made very large amounts of money at $120 oil. and they're now worried about having too much money in the Middle East, given the macro, the geopolitical issues, etc. And we're seeing large amounts of that sort of capital, whether through the private banks or individually, being deployed. And that's in contrast, I think, to the governments, who are obviously finding it more difficult to fund their infrastructure obligations, etc. So I think private capital coming out of areas which are affected by geopolitical issues is one large factor in cross-border investment.
Interesting, and that's certainly a topic that I want to revisit. But before we do that, more call it emerging type markets in Europe. Ismael, what have you been experiencing in terms of investors coming into your market on a cross-border basis?
Completely different panorama. Is clearly Iberian Peninsula is lagging behind in terms of investment patterns. We are now in the relatively early phase of recovery. I mean, between 2008 and 2012, Iberian Peninsula was a war zone. Nobody wanted to get there. I remember the problems we had in 2009 trying to line up some capital to do a cash flow based, pure core deal in Spain with a...
At what yield though? At the time?
Close to 7% with an extraordinary credit counterparty. It was 30 years compulsory contract. So it was...
Wow.
It was, my son Santi would have signed on that deal, but at the time it was impossible to do it. We were turned down by a couple of super big names, and eventually we ended up partnering with Charlie and his fund and doing it. The patterns are completely different. Between 2008 and 12, nobody there. 12 to 14, we started to see some inbound flow of capital. All of it, or most of it, American.
What type of capital?
Opportunistic, as you can imagine. Then that capital moved into more UK kind of capital, which is a little bit more value add than opportunistic. And only recently we are seeing that capital being replaced by purely institutional capital, mainly German and French, insurance companies, some Middle Eastern, some sovereign wealth funds, etc. So only now we are seeing the embryo of that kind of replacement of opportunistic / value add with more core plus type of capital.
Do you see any North American pension funds coming into your fund?
Yes, I mean our shareholding list is full of U.S. pension funds. I mean they are dividend seekers, and cash flow yields in Spain, given the acquisition prices, can be very high or relatively high.
And what sort of range are we looking at? We
are currently distributing 80% of our FFO, and we are providing something in the region of 4 3/4. And if we are measured by a cash flow yield, we are more in the 6 and a change. Wow. So it's high. So for an average U.S. pension fund, this is fantastic because it's absolutely recurring. It's relatively steady, predictable. I mean, if you are devoted to commercial real estate and you have a relatively small development component, predictability of your P&L is close to a Swiss clock. I mean, you can predict it with pinpoint accuracy. So clearly, what I see here is completely different from my world. In my world, for example, the statistical base is completely different. I mean, we are being accounted for official statistic purposes as national investment, but 90% of our capital is cross-border. So it's exactly the contrary. So we are probably, I mean, I don't know, but 85, 90% of the market now is being dominated by foreign investment.
I know we talked about REIT earlier, which is a relatively new structures in Spain. How much do you think that helped drive the inbound capital coming in the last few years?
A lot, because it's an absolutely familiar figure for international investors, particularly for the American and the British. And well, once the haphazard law that regulated REITs in 2009 was shelved, and a new law was enacted and passed at the end of 2012, new REITs were created, new public REITs were created, with a very similar structure as compared to the US model. So for US investors, it was a relatively easy recognition. I mean, they say, oh, this is exactly what I am accustomed to invest in here. So the flow of cross-border capital clearly, multiplied by several figures.
It's interesting to see how innovation in structure helped drive some of that. Matt, you talk about J-REITs, you talk about the Australian structures. Have you seen similar experiences, looking back, probably a little bit longer?
Yeah, I think the the introduction of the REIT format around the world is one of the leading large format drivers that we'll see, and it really has still relatively a long ways to go. In most of the European countries are lagging well behind Spain. Spain has really been an innovator there. Japan introduced the law in 2000, and Japan has really been an innovator. It more follows the Australian model than the US model, and most of the J-REITs are externally managed as opposed to internally managed, which is the predominant US model. We actually, in the US, use REITs in almost all of our funds because as a tax matter, it actually simplifies cross-border capital for almost all of the investors. So even when REITs are not visible, they actually are quite influential. And one last comment I'd make about Japan, we're seeing that sort of the wall around Japan is beginning to break down a little bit, and we should be seeing a little more use of the J-REIT structure to invest outside of Japan than we have in the past. And that will become a little more important. In part, that's a way to have Japanese capital participate in cross-border flows in a way that has been actually quite restrained today.
Yep.
And I think that vehicle will probably be fairly successful over the next decade. It will, being Japan, it will move slowly, but it will move in that direction. So I think that's an interesting trend.
Do you think that they will naturally gravitate towards structures similar to themselves with an open-ended vehicle that they're familiar with?
Well, I think what they will do is, I think Japanese capital will invest in a structure they like and are familiar with, because the J-REIT structure has now been accepted as a well-governed yield vehicle in the domestic market. There's a lot of retained savings in the country. And because that vehicle is accepted, I think it will be a vehicle for domestic savings in Japan to be invested outside of Japan. I think the J-REIT vehicle itself will be that vehicle. I think that it will take longer for the Japanese to fully accept some of the other structures. They do accept, some of the larger institutions are beginning to accept the open-end fund structure and other vehicles, but the Japanese had a very unfortunate history of investing at exactly the wrong time, and that is still, and when you talk to them, that's still at the forefront of mind. And so there's a natural caution, because the first time they really attempted that, it didn't end well.
Now, at the other end of the spectrum, we touch up on private capital, almost, Charles, you mentioned the super high net worth that is moving blocks of capital. It's not similar to an institutions. And Brian, I know you dealt with what I will call is probably the 5 to 25 million net worth type investors, high net worth. Which is another area that in my world I'm seeing a lot, is how do you mobilize private high net worth capital in an efficient manner and have that work with, potentially work with institutional capital on a side-by-side basis in a transaction. Brian?
That's a lot of what we do. That's our everyday. I think a lot of it is driven for us by the deal. I think we have a stable of investors that are very educated today and are very motivated to put money to work within the U.S., which makes it a lot easier. And then it's setting up that capital stack within each individual investment. So when we go out and we look at our investment, we know already who we think it fits and how it's going to fit, because our structure's evolved. We're actually in the process of changing that because of different economic and social changes, and especially tax changes. Obviously here in the U.S., FERPT is changing, which is creating our institutional side is looking at different ways for them to invest, which will take that tax play out of it, which is going to change how our high net worth come alongside of them. But for the high net worth on our side, they are very flexible on how they want to invest, and I think being along the side of a large institution gives them more comfort in some of the deals that we're doing today.
Some of the challenge that we have lived in our world dealing with Asian high net worth capital, and that's if we were to host this panel in Hong Kong, the first question is how do you deal with control? Because we are, I guess, known to be control freaks, and sometimes to have them rise side by side with an institutional vehicle is not always easy. Do you have that issue with South American investors?
No, I mean, there's always the control issue. I can't say no, but we've been fortunate with our track record that a lot of the control is maintained within our board, and it allows us a lot of flexibility when we're investing to structure the deal so that the control really relies with us instead of either party, which is very important. But it's always, especially with new investors as we grow here, it's a long conversation to get everyone comfortable with who's going to be in control of the funds.
Some of that innovations we probably need to pick up from you. Charles, do you deal with private high net worths much in your
I think I just would observe that the smaller high net worths probably have been most noticeable in the UK, particularly in buying into the residential sector, because you've got lot sizes that are small enough. They've seen it as been interesting. It's a place to park capital, maybe to rent, etc. But we've seen a lot of high net worth individual capital flowing into the UK residential market. Maybe too much. I mean, we may be seeing a little correction in that. We'll see how that goes. I think that for the reason you say, control is a big issue. We see most of the high net worth capital into our type of activity through intermediaries like Swiss banks or Swiss or sometimes UK-based banks that from the Middle East or from Asia. So some of it's sort of disguised that way. I think the big issue is really, if you talk about high net worth individuals, some of them are so large that actually they become family offices or small institutions, and they will go for commercial assets, but they tend to go and buy those outright. They don't terribly want to go into they're not very fond of clubs unless it's with other high net worths who they perhaps know.
Right.
That's how I see it anyway.
Yeah. But among your investor base, do you access wealth managers as part of your investor base at all?
Yes. I mean, of course, for like any manager, 150 million from an institution is a lot easier than 2 or 3 million from a high net worth group. But we certainly have no bias towards it, and family offices, are quite prevalent within our investor base. But I think there's less appetite from the high net worths to go into commingled funds, perhaps, at this point in time.
Matt, when we first started talking, and due to my own ignorance, I've always thought that UBS wealth managers will work closely with the investment management group. Back to Charles' earlier point, do you see that much? Do you see that as a trend that you capitalize on, or what has been wealth managers, I guess, influence in terms of on real estate, either from a buy-side perspective or from your investors' base perspective?
Right. From our perspective, being part of one of the world's largest wealth managers, that's where the wealth management capital that we invest is coming from. It's a variety of formats. In some places, it's club transactions. Our European transactions tend to be that. We have some mega rich people who we're doing separate accounts for, where they will be buying exactly the same as you were saying. They really don't want to be with anybody else. And so they have enough capital that they're their own institution. And those are actually fairly efficient to deal with, because the control issue, which is absolutely central, is easy because they control everything. The difficulty is getting them to make decisions in an appropriate period of time, and that is not ever easy. But when you're not pairing them with someone else, it actually makes it possible. The club kinds of transactions we're doing, as I was saying, are mostly in Europe, as opposed to into the U.S. And In those transactions, the group has a chance to decide when a transaction is presented to them, whether they want to invest or not. They have a time frame that they have to respond. They actually have to pay a commitment fee to be part of the club. And so if they turn down 3 transactions, they're actually out of the club. We found that that set of incentives, that in fact having to pay a commitment fee to show have transactions be shown to them, is a really efficient way to separate the wheat from the chaff, if you will. But it's still, I would certainly agree with the point that it's easier to find 150 million of institutional capital than 5 million of private wealth. And part of that is because the private wealth clients are used to making all decisions and being fully in charge, and do not fully accept the role of an institutional manager as actually adding value, because they always know more than you do. It doesn't matter. They have more money than you do, so therefore they know a lot more than you do. So that information asymmetry, if you will, always makes those transactions more challenging.
That's interesting. But I have to admit, this is the first time I've heard of the commitment fee as a mechanism to manage them. So allow me to dig a little bit deeper into that. They pay a commitment fee, and does that get rolled back into the deal if they actually invest?
It does. So they get credit for it. It's not as if the money is gone. It's really a way to ensure that they're engaged in the process of actually choosing investments, as opposed to using this as a way to have a more interesting vacation and a more interesting way to brag about what they're doing than other people are doing.
That's a great mechanism. This is learning a lot that's innovation within our world. Now, on the open-ended fund vehicle, do you have one share class that's really primarily geared towards the institutions, or there's a separate share class for other capital type as well?
So that's a great question. And the answer is it depends. We have built a share class here in the U.S. in one of our open-end value-added funds that's just for our wealth management channel.
I see.
And they invest really into the same pool of assets, but it is a vehicle that allows the financial advisor to be paid. This is all about paying the intermediary. And so, but when they're invested, they're actually investing in a share class in the same pool of assets that the institutions are. They have no control at all, because their right is to invest with the manager, and then the manager makes all the investment decisions, fully discretionary. And because it's an open-end vehicle, they have an opportunity to request redemption. So it's an unusual vehicle for the private wealth market. It's surprising to me that it is almost unknown, but over time, I think it will become better known.
But when you say they request redemption on the same basis as the institutional has the rights to.
Exactly.
So there's no differentiation.
There's no differentiation there. And in fact, the selling point is that you should invest more like institutions. Institutions frequently use open-end quarterly valued vehicles as a way to gain exposure to high-quality assets. You don't actually need to take on the event risk of being the only investor in this one property. You should share that event risk with others, but that means that you have to accept the fact that you don't have the liquidity you would have if you invested in a public REIT, say, which you could liquidate in one day in almost all cases.
Do you do additional structuring for that share class in order to get private high net worth investors coming in from different parts of the world?
At this point, for that vehicle, we've only done it for U.S. investors, but I would fully anticipate that that's the next step.
Got it. Ismael, you're on the public vehicle side. Do you see much? It's primarily dominated still by institutional investors among your investor space, or do you anticipate the private high net worths coming in?
They will.
Much at all?
They will. It's a familiarization process. First, in the recent IPOs of all the REITs in Spain, nobody has tapped into the retail channel, owing mainly to the complexity of the European minority protection legislation. So it's so complicated to distribute your stock among private individuals, and the risk of getting lawsuit is so high that you basically, like water, you basically skip the minority and only plays with sophisticated investors. So that first. Second, the retail market, the private individual in Spain is still, in a way, licking the scars from the past recession. So they have been so heavily battered by the recent slump in residential prices that in many cases they have lost so much money that, that they don't even go close to anything which is called real estate. So they stay aside from any real estate investments. So it will take time and market education to distribute dividends on a constant basis recurrently so that they see little by little that this is a reality and that they can invest 100,000 euros from their retirement money into a REIT and they will receive 4,500 with which they can go and spend the summer holidays in somewhere in the coast in Spain. And when that becomes evident for them, little by little they will be re-entering that space or the capital of the Spanish REITs. But so far, this is mainly an institutional business in Spain.
Do you get international, non-Spanish financial institutions knocking on your door, like wealth managers, the cities of the world?
Yes, they tend to group the interest of their international investors, and they put it in the capital. We have some of those. We have some, big wealth managers that are invested into the capital, but these are either fund of funds or they are like small separate accounts that they set up for clients and they invest in Spanish REITs.
I'm actually very glad to hear that because a couple of years ago in Asia, I hear a lot among my family office investors keep asking me about, what do you think about Spanish real estate? I'm like, why, it might be good, but is it for you? That's constantly the questions, and it's great to actually hear private high net worths using the FI channels properly to get access to I guess, more emerging markets real estate. Now, given we touch upon the topics of innovations a bit more on the capital side in terms of how to access different pockets of capital, and certainly great to hear a lot of knowledge base here. On the product side, just briefly touch upon that, do you see, sort of looking forward, different, I should say, cross-border capital driving, like UK student housing, I think was one with US capital, who's familiar with the product type, going into another developed market, pushing for a different product type. Do you see emergence of new product type that is coming up in your home markets that's driven by cross-border capital, or just driven perhaps by this phase of real estate development?
Well, I think the world is such a small place these days that it doesn't take long for concepts to move from one place to the other. I do think innovation, in many cases starts in this part of the world, and I spent 15 years living here and then going back to the UK, and you clearly could see the trends that came from here and moved there, much more than perhaps the other way around. I'm not sure that I can answer the question because I don't spend enough time in Asia looking at whether or not senior housing activities, etc., are being taken on in China or indeed in some of the other Asian countries from a model here. I can't really tell that. I do think that there are changes that are being brought about more by technology than by necessarily geographical changes. So, where people are prepared to live, the importance of transportation, the importance of Wi-Fi, and I think that if you look and see the individual of 25 to 35-year-old is not prepared necessarily to go and sit in an office building. I'm sure it's much spoken about the millennials or whatever. I think there will be tremendous changes in the way that people will run their businesses. They tell me that Berlin is an interesting city because for the reason that for the time that it was divided, it was never really the focus of major corporate relocations. I think Sony was one which was sort of highlighted as being about the only major relocation. And so the Berlin at the moment is growing very, very strongly. And this is on the back of new businesses, people of a younger age, whether they're graduating from the university system or moving anyway because of the cultural and other activities that Berlin is famous for, And the businesses there are the startup and startup businesses. And people actually, their residential requirements are similar to like a student housing requirement. They go, they spend time, and then they may go back somewhere else, etc. But this is not a typical European city structure. And I wonder whether or not that's going to move into other markets. If you look and see really the growth of Berlin as a major city, I think it's the largest German city, but has the smallest amount of corporate, major Fortune 500 companies, etc. It'll be interesting to see how Berlin emerges over the course of the next 15 to 20 years. And my personal view is that that will be the substance of growth as we go forward, and that Berlin will be one of the major cities to watch over the next 15 to 20 years.
Interesting. That's interesting. Touching briefly on the same trend, we talk about retail a lot, the internet shopping impacting U.S. real estate from a retail format. Do you see that in Europe much?
Yes, I mean, I'm not a retail specialist, but I was amazed to go to one of the Westfield shopping centres in West London. It's not something I do out of preference, but but anyway, I went to the...
You do have to visit the Galleria while you're here, though.
Thank you. Thank you.
That's very essential.
But the amount of gastronomy, as they like to call it, I'm not sure it's gastronomy, but anyway, food that they have in a shopping centre like that is enormous compared to what it used to be. Not only that, I was asked whether I had a reservation in the restaurant in the shopping centre. And I looked at them with absolute amazement. So I do think there are some interesting changes that are going on in terms of how the leisure element of shopping centres will become more and more important, and perhaps the actual shopping, this will be a showcase for people to go and look at things, and then they'll have things delivered home later. I'm very surprised to see that, and I've heard it on a few the retail specialists that there are some changes. You probably know better, Ismael, you're a specialist.
We are more, given our size, we cannot be pioneers. We are simply settlers. So we are waiting for Unibail and Klépierre to fight the online shopping or try to derive income from the online shopping sales, which is now currently the battle which is happening on the ground. I mean, your shopping centers have become part points for sale and part points for simply pickup. So your average shop, you have a traffic, probably at present can be 75% is people who goes there actually to buy something, to try on and buy. But there is 25% that simply goes to pick up something that they have ordered online, and they prefer to physically pick up because they can try on. If they don't like it, they can give it back, and they don't need to put in motion the reverse logistic side of online shopping. So all the big retailers are now trying to fight that, and they are trying to obtain some sort of regulation that allows them to pick up part of the online sales revenue in their variable rents in the shopping centers.
Wow,
because we are small, we cannot afford the luxury. So the only thing is we are specializing the company in city center shopping centers, so that at least as simply a pickup point for online sales, the retailers will be interested in keeping a shop open at our centers. The centers which are suffering now, which by the way is 75% of the market, are the ones which are spread with a sneeze pattern over every radius exit of a big city. So you either concentrate on the super dominant resort shopping center, the posh people calls them resort shopping centers. So you either focus on that, which is centers with more than 3 hours shopping experience. So people goes there, parks their car, and then parks the kids, and then goes and shops. Or you move to the other side of the spectrum, and you concentrate on the city center malls, which are normally smaller in size, but they are fantastic pickup points for online sales. All the middle is basically where the war is happening right now, and there will be, of course, winners and losers. I mean, all of them are like between 60 and 80% occupied, fighting each other. Eventually, some of them will end up emerging with a 90% occupancy, and some others will go down to a 30, 40, which is normally the death of a shopping center. Here in the US, much more advanced. And I have been visiting some web pages here. Like there is one called deadmalls.com, and I have been trying to learn about what happens to a shopping center which becomes out of favor for the market. And it's complicated because in the US, yes, you have, the depth of your market is bigger, so some of them are being transformed into medical shopping centers. Right. In Spain, the concept of a medical shopping center is probably still 10 or 15 years from happening. You have also community shopping centers. Again, that probably is between 25 and 30 years from happening. So the possibility to re-engineer a dead shopping center in Europe is of course smaller than here in the US.
But there's still some cross-border knowledge base that might occur.
The speed at which knowledge and capital travel these days is enormous. So at the end, what we do in Spain is not dissimilar. I mean, we are already, for example, entering the high cube, full automatization era in logistics. I mean, now all of our logistic operators, the 3PLs, now don't want higher cube. So the average 14-meter high logistic space is no longer valid for them. They want something which is 30 and above. They want rails on the ground so that they can put now 5 years ago you went in rush hour to a logistic shed and it was a chaos of people shouting over a microphone and the toros, I don't know how you call it, the forklifts. Yeah. The forklifts going back and forth, and it was a complete chaos, but it was wonderful. I mean, if you like real estate, you like that. Today, you go there, and they look like a Panamax cargo ship. It's only the captain and 3 guys, one for oiling, the other is the mechanical engineer, and the other one is the cook. In the logistic space, it's exactly the same. I mean, you go there, it's fully automated, and you go at 7 a.m. in the morning, where 5 years ago it was full of people, and you see nobody. Everything is robots going here and there, and that moves very quickly like capital across all countries. So, we are, of course, again, we are more settlers than pioneers because of the size of our real estate market, which is tiny. But still, we learn quite quickly.
On that innovation point, I was in Shanghai recently and toured an industrial property, and it in many respects looks like what you would see at a contemporary U.S. industrial property. The 2 biggest differences were that it was on 3 levels, and it was remarkably inefficient, but it was because of the cost of land was probably a multiple of 10x what the cost of land in the U.S. would be. And it wasn't the high cube that you would expected, and it was, we saw one food retailer that was doing it, and it really looked as though the setup was to employ the maximum number of people possible. I mean, there were 400 people picking and putting things into boxes.
Wow. And
part of it was that they were trying to overcome the inefficiency of a new regulation that required relabeling. So that felt very Western, that they had to change the labeling on a product. The second biggest difference of why it felt different from what you would see in the US is that it's on a 30-year ground lease with no extension option, and it was expected that it would trade at inside a 5% cap rate.
Wow.
I was happy to visit it, but not to invest in it. I couldn't understand why you would have, why a 30-year ground lease with no extension options would trade at such a low cap rate, given that a lot of the leases were short-term, but there's other land that you can build on there. So a lot of the technology that you're seeing in Western countries was transferred, but some of the land ownership patterns are so fundamentally different, and there's so much uncertainty as to, well, what's going to happen at that point.
That's right.
And no one knows.
Yeah, and it makes you wonder how successful these quote-unquote innovation is going to be. We have been thoroughly warned. We're running out of time, so, but is it okay to take a couple of Q&A?
Questions?
Hi, Sam Siddiqui from Kuwait. One of the charts you put up showed the massive investment coming in from China and Hong Kong. There's been some news recently that China's looking at that and trying to dampen some of that. Do they have any effective means of clamping down on that? Do we expect that to happen, or you can't stop the flows?
Yeah, great question. So the question is, well, I guess everyone could hear that. So yeah, I would say that 2015, and I didn't get into it, I was asking the question, is 2015 sort of an anomaly? One of the reasons that 2015 was so high for cross-border capital was that in anticipation of increased capital restrictions coming from China. In general, I think the answer is yes, that China can effectively restrict some of the cross-border capitals. Clearly, the government does not want to see as high an outflow as is currently happening. So there's a tension there. I think that it is very natural that capital will want to flow outside of China more than it has in the past because it's been really very artificially constrained. So I think that the tension to increase will be met by increasing resistance from the government to restrain it so that there's more domestic investment that will take place. So I think that my guess is that 2016 will see total investment from China in the U.S. actually at a lower level, but I think that will be fine. I think 2015, I was in Beijing last summer and explaining why it is that a large institution should invest in a diversified way with other institutions. And the chief investment officer, very knowledgeable and experienced person, we're sitting in a room that looked like the room that that Henry Kissinger might have met Zhou Enlai in 1972, with these giant chairs that looked like, with translators and all this. And she says, well, I hear all that, and it all makes sense, but I'm getting a lot of pressure to buy a big New York hotel.
Yeah.
So I think that there is that pressure internally, but I think that they'll probably, we won't see another transaction like the Waldorf that we saw last year. But there will be pressure to do transactions like that.